Okay, now you've noticed the screen probably changed a little bit. I've gone ahead and positioned it so that we've got some room to work on the remaining transactions. So let's start out with the July 17th transaction. Here we've received the payment from the Mayor Company for the maturity value of its dishonored note plus interest for 46 days beyond the maturity at 8%. So we've got a new transaction to record on the 17th. We know we're receiving cash, and we know we're going to record some additional interest revenue, and they're paying off what they owed us, including past interest. Okay, well, if we slide on up, we know the amount that we had recorded was that 4202. So that's going to go away because they're paying us for what they owe us. We have an additional interest to calculate, which is now the 4202 times 8%, the agreed rate, times an additional 46 days. Okay, so that's $43. And if we sum these, that's the debits, so that the debits equal the credits. That's the amount of cash we're going to receive. And we need to label this entry as to record cash received. I'm going to abbreviate here, on account plus additional interest. Okay? And all of these would be indented proper form. Okay? Alright, that takes care of July 17th. Now on August 7, we accept a $5,440 90-day 10% note on this day, granting a time extension for past due accounts receivable of Birch and Buyer. Okay, this should look real familiar. Now, we've done a couple of these. So, let's go ahead and record that one. We are going to debit an account called Notes Receivable. And we're going to do that in the amount of $5,440. All we're going to do is back off an account called Accounts Receivable. I've just copied it from above to save some typing there. Right? And this would be to record note received on account, because we're getting a note in replace of a receivable that was owed to us. Okay. That takes care of August 7th. Now, on September 3rd, we have a new transaction. We accept a 2080 60-day 10% note dated September 3rd, granting Kevin York a time extension on his past due account. Okay, let me slide the screen down so we have some room to record that. Okay. I see I've got a typo here. Let's fix it. Going to copy that from there, change the name to 9-3 instead of Birch and Buyer. This one is from York. And September 3rd was $2,080 was the dollar amount. So what we've done on this one is we've recorded a note received on account as well. Now we get to November 2nd. And on November 2nd, we receive payment of principal from York on the September 3rd note. Okay, let's do the easy part first. We know we're going to debit cash. We know we need to record some interest revenue. And we know we need to reduce the notes receivable. In fact, we need to reduce all of it because they've paid it, so the note goes away. Right? And the easy part first says that note is equal to that dollar amount the interest revenue would be equal to 2,080 times what? 10% on the York note? That's correct. Times 60 days. So this one would be equal the interest plus interest, the principal amount. And then we just need to say to record cash received, I'm going to abbreviate on the note, plus interest. Okay, let's slide down, give us some more room now. On 11-5, what happens on November 5th? We receive payment from Birch and Buyer for the August 7th. Okay, so pretty much more of the same. Let's copy this from here. Right? And that amount is going to be equal to whatever we had on the Birch and Buyer, which was what? Oh, but there is a twist on this one. On the Birch, or is there not a twist? Nope, this one's straightforward too. Got some room. Birch and Buyer was equal to, let's find that amount, 55,440. Yep, I'll slide back up so you can see that I put that in. The interest calculation would be equal that 5,440. This time I'll just use relative referencing rather than typing it in, times Birch and Buyer was 10% also, times 90 days divided by 360 is using the days in the year, which is fairly common. Sum that, we get the proper amount, and we've taken care of the 11-5 transaction. So the last transaction we have to work through is December 1st. Let's give ourselves some room again so we can watch this. And on December 1st, we wrote off the Halam account against allowance for doubtful accounts. And this is just the allowance method. So we're going to reduce our accounts receivable by debiting the allowance account. And I believe the amount was 2414, but let's go make sure that's what we had on our account. Yep, there it is, 2414. Indent that so it's in the proper form, and then we'll say to record account write-off. Okay, indent that a little bit, and we've taken care of the requirements in Part 1. Now, let's take a look at the requirements for Part 2. What reporting is necessary when a business pledges receivables as security for a loan, and the loan is still outstanding at the end of the period? Explain this reason for this requirement and the accounting principles being satisfied. Okay, when a business pledges its receivables as security for the loan, and the loan is still outstanding at the period end, we have a disclosure issue, and we must disclose that that the receivables are security in the notes to the financial statements. And this is a requirement because the business has committed a portion of its assets to cover a specific portion of its liabilities. And what that says then is if the business dishonors its obligations, the creditor can claim that amount of receivables that were identified in the pledge as collateral to cover the loan. And the principle that involved is the full disclosure principle. We want to make sure we're fully disclosing the transaction to the readers of the financial statements. Okay, I'll slide up. That takes care of all the problems that we have on this problem. Okay, so I'll just go slowly down now so you can get a quick review of all the transactions we made. covered quite a bit dealing with notes receivable in this problem. And then we also tackled the analysis component, which was requirement 2.